Hello and welcome to Business Morning. I am Bisi Adebayo. Now, lately, the central bank has been reeling out several circulars, all in a bid to sanitize the financial market environment, which has actually been complicated by the effects of the COVID-19 pandemic. But the most recent policy that we've seen from the regulator is the directive on minimum interest rate on savings deposits, which has now been reduced to a minimum of 10% of the monetary policy rate, or 1.25% of the current MPR of 12.5%. And that new directive, which took effect yesterday, September the 1st, is a clear departure from the previous minimum of 30% of MPR, or 3.7% or 3.75% policy that obtained before now. And one of the objectives of the monetary policy as contained in the CBN circular is to help banks to cushion the effects of their credit flows to the real sector, effective yesterday, Tuesday, September the 1st, 2020. Well, joining us now to make sense of this new policy is the Chief Executive Officer of Leishton Consulting and Board Gov, Dr. Macleish Otwedon. Good morning, Mr. Otwedon. Thanks for coming on the program.
Hey, thank you very much, and thank you for having me.
All right, let's begin this conversation with you giving us your impression of this new policy from the CBN. Do you think it's necessary, and why?
Thank you, and viewers. I think if you look at the trend, it starts from what is the CBN saying in the market, and if you look at it, you find out that other rates are also trending downwards. Most countries, we always look at your treasury bills rate, and so if you look at the 90-day, the 182-day, it's been trending somewhat 1.4, 1.18 respectively. And so what that tells you is that your savings account deposit rate is not sustainable to be at 3.75%, which is when you look at that benchmark of 30% against the CBN monetary policy rate. And so that tells you that there needs to be proper alignment. And I think what CBN has done is to actually align the risk-free rate of savings account to align with the other risk-free rate, which is your treasury bills. And so you have it now 10% of the MPR, which takes it to about 1.25, right? But I think the whole ulabaloo about the 10% was the way it was captured in the circular. And so people were thinking it was outright 10% interest rate on savings account. And so it's good for depositors to understand, first of all, that it is not an outright 10% per annum on their deposit.
So what is it?
It is 10% on the monetary policy rate. And the last monetary policy rate was, which was retained in July, was 12.5%. And so when you look at 10% of 12.5 gives you 1.25, right? But this is not really supposed to be a matter that should really be topical, because if you look at from 2013, when CBN started having what you would call when CBN issued the revised guide to bank charges, that was in March 2013. It was outrightly 30%, and in 2017, when the guide to charges for banks and non-banking financial, it was also 13. And the circular that was issued on the guide to bank charges for 20th of December 2019, which came into effect on the 1st of January 2020, was actually 30% of the MPR. So it has always been. But when you see a circular come out like the way this did, it's also important for our regulators to have that understanding that their stakeholders goes beyond the target, which is the deposit money banks. And so you need to, first of all, even state explicitly, it shouldn't be implied, the objective, and also make the other stakeholders to understand that this is on the MPR, even though it was stated, but it wasn't really, as in, you need to be a financially literate person to actually understand what that meant.
So we need more clarity.
It's always definitely. So one paragraph would have been made it clear. So it would not have really been an headline, because it is just updating your guide to charges for banks, financial and non-banking financial institutions that came into effect in January 2020.
So, well, whether we have, that much clarity or not, of course, from what you're saying, the customers really have nothing to worry about. But the policy implies a reduction in banks' funding costs. So tell us what will be the implication for customer deposits or how negative it will be for customers. I'm sure many would like to know that still.
Definitely, if your interest rate is, so I think it's basic, if you are earning 3.75, then suddenly it comes to 1.25, that is more than a 50% reduction. And so it has direct implication. But so when you look at the whole concept of interest rate in Nigeria, it's convoluted. And first of all, you also have banks having a challenge, which is, what is the challenge? There is the loan to deposit ratio of 65% that they need to offer. And so the question is that when I have to give a loan as a bank, you are giving that loan to people who you think can repay those loans, right? And so the question is, if you are, first of all, your cost of funding of savings account is 3%, and on the other end, you are supposed to be giving it out, but you are not able. And there's a penalty from CBN, which is the differential between the amount you're able to give and the 65% would have to have additional, CRR, which is the cash reserve ratio of 50%. So there's also an implication. And so what you begin to look at, okay, how do you strike a balance within the system? And that is on the one hand now. So you have, now this will be favorable to the banks because one, it's reduction in the cost of funding. But if you also look at it, it's also has an adverse effect on the deposit, the retail sector, because really most of the savings account are for the retail sector. But the other thing you also look at is how does this whole reduction now come into play with regard to financial inclusion? Because you actually want people, retail customers, you want to bring them into the banking system. And so so the question is that what are the alternative assets that they are going to be looking at right now? So it becomes, so will it be better for them to put it on the bottom of their pillows rather than bringing it to the bank? Because they will say, look, there's already a challenge before now, because there's already a caveat, which is that you won't enjoy even the 30% as it's were, and even this if you withdraw more than 4 times in a month.
Okay.
But what I've also noticed is that most of the retail depositors typically withdraw more than that, and so they are likely not to benefit. So,
all right, Mr. Otweno, please just hold on to your thoughts. We'll continue this conversation shortly.
Much.
We'll be back in just a moment. Please stay with us. Welcome back. We still have with us the Chief Executive Officer of Relation Consulting and Board Gov, Mr. Maklaish Otweno, here with us in the studio, and is talking about the CBN's new policy on retail banking. Thank you, Mr. Otweno, for staying with us.
Thank you very much.
All right, so let's continue the conversation now. Of course, some analysts are of the view that this policy might be insignificant for most savings accounts, and that's due to the stringent withdrawal limits, which is, of course, just like you mentioned, once the withdrawal exceeds 3 times in a month, an account holder becomes ineligible for this interest. Do you agree that these conditions should limit the effectiveness of this policy?
Definitely. I think it is good because if you look at most savings account in Nigeria, it's mostly the retail sector, and most of the retail depositors really, in fact, more often than not, they will withdraw more than 4 times, right? But if you have left the rate, so there's the issue of arbitrage, right? If the rate has been left at 3.75 and you have other risk-free assets significantly lower, then you will see those that are above the retail sector come into the deposit savings account. And so the implication of that is then it will have a significant effect, right? But because it has been brought down, then there will be no much incentive for those major players to come into that space. But so overall, it won't have a material effect. But again, if you look at it, even the cost of funding has actually been very low for some banks. So we don't expect much. But overall, from a Nigerian perspective, the aspiration and hope is that overall cost of borrowing, right, to the real sector should significantly come down. And so I'm still very hopeful that one day we will get to a situation where we can bring the cost of borrowing to a single digit, and that will be very good for the country. But we can, so it is very important for the regulator, the CBN, to not just end with this, but also look at what are some of the interventions. And again, you can give credit to CBN for the LDR strategy, which has also made banks to be more committed to giving more attention to the risk sector, and also some of the intervention with regard to the restrictions to treasury bills for retail investors. And so those are really, in terms of even the open market operations and all that for non-banking corporate. So there's really be a lot of interventions. But again, what I will always believe from a Nigerian perspective is that there must be a whole level of rigor and an helicopter view of how some of these policies have interplay and affect the different stakeholders within the system, so that at the end of the day, then there will be a purpose, an objective, and that objective should be for the overall benefit of the Nigerian economy.
Now, possibly talking about, of course, some of the CBN interventions that you mentioned. Of course, the CBN says it's satisfied with the recent declining trend in market rates in the banking sector, and that follows the implementation of some of its economic stimulating policies. So tell us, what role did the minimum lending rate of 65% and the exclusion of the non-bank corporates from OMO auctions play in this regard?
So if you look at what was happening prior to some of these interventions, then it will become very clear in terms of the what has been achieved. So before now, you find out that depositors come in, a lot of deposit come in, and what happens? You give the depositors 3%, 3.75, but at a time, Treasury bills was going for as high as 20%, 18%, and other. But again, you find out that generally in finance investment, it's always very clear. If I can have what you call invest in a risk-free asset, like Treasury bills, right, and I get a return of 17%, what is the motivation for me to go to the risk sector and invest? It is pretty difficult. But when CBN started with that and now brought these, so when you stop that as a regulator to say restriction to retail and all that with regard to Treasury bills and the OMO for non-banking corporate, what it does is that, okay, where should the banks now put these funds, right? And so something that would be reasonable was what CBN did, which was to say, okay, 65%, I think it started from 58, of your deposit must go to lending. And they mentioned some specific risk sector that it must even go as far as 150%. And so what that does is that, it forces the hands of the deposit money banks to now put funding, and to really fund the risk sector. And what you have with that is that, which is what we need, because you want to be able to fund the issue of production, because that is what will create jobs in the country. And I'm a firm believer in Nigeria that, look, we need to create jobs. And how to create jobs is to fund the risk sector and also use our regulations, our laws, be intentional about those laws to ensure that it creates opportunities, activities that would definitely create jobs. So you can see that has significantly impacted. And again, enforcement is also key. And so CBN has been very bullish in terms of its enforcement to ensure that once you are not able to meet that minimum of 65%, then the differential is subjected to the 50% rate. And so we expect more intervention. And I always say, ultimately, if we don't get to where these interest rates to the real sector comes down significantly, then we wouldn't have really achieved what I think it should be the ultimate goal.
Now, when you look at the half-year financial results of one of the Tier 1 lenders, which was released late yesterday wasn't impressive, even though they offered to pay dividends from their retained earnings. What do you see the interest rate regime changing for such banks during this pandemic period of COVID-19?
So it's, there are some years in the history of the world that have been very challenging, and you can for the children of students of history, the Great Depression of the late 20s and the 1920s and early 1930s was very significant. Then the global financial crisis of 2008 was another significant time. And if you look at it, it means that all hands must be on deck. And not only the monetary policy side now, but the fiscal policy would have to come to play. But if you look at from the banking perspective, what the banks, which is what they've already started doing, which is look at how they can channel money to the real sector. But what we also hope is that if the banks are doing their part, but if we as the government, the fiscal side, are not able to concentrate and mitigate the effect of COVID, then the impact is going to, it's also have what they call a spiral negative effect on every sector of the economy. But what I also believe from the banking side is to now also begin to look at opportunities. So first of all, you have this reduction in their cost of funds now. We have little impact on the cost of the funds that they get, so which is positive. Then they also look at other avenue in terms of what are the sectors that are more lucrative right now, investment friendly, and begin to channel. But at the end of the day, you have to take 2020 as a year that would have some missed challenges. For some, it will be good. And if you also look at it, in terms of the online banking activities has also been, a phenomenon. And so they will also take advantage of. If you also look at it again, the FX volatility from a banking side, a lot of banks have benefited from the volatility. And so at the end of the day, some banks will still come out pretty good, and some of them will face challenges. But I believe that as much as we are able to tackle COVID challenges and bring the country to normalcy, then 2021 we should come out pretty good.
Yes, you say that some banks will come out pretty good, but then it's also estimated that the impacts of this policy, when you look at it on banks' earnings, will average an increase of around 8% growth in the 2020 profit before tax. Do you actually agree with that?
Yes, I agree with that, because if you look at a lot of this intervention, and that is why it's good to have a regulator that is very active and sometimes ready to support the system. And what we're talking about savings account now, if you look at it, is the regulator having the lens to see that, look, we need to balance the interplay, the interest within the system, right? So depositors, you need to, because I told you, like, if you bring all these deposits into the bank and they are not able to also give that to borrowers, then there's always a challenge, because you're going to have idle funds. And what would that imply to the economy? What it means is that banks will get to a stage where they will be turning depositors back. We're going to get to that, because it's not attractive. And so this intervention, for me, at the end of the day, are aligned with those predictions that, year on year would over around maybe between 5 and maybe 8%.
Now, when you look at banks like GT Bank and Zenith Bank, which are banks that already have lower funding costs compared to other lenders, how much of benefits do they stand to gain from this policy?
They don't really stand. It's almost insignificant for them, because it's already very low for them. So I really don't see much for them. I think for them it's just business as usual. And like I've also said, is that the overall policy really is not something that ought to have actually made any headline, if not for the fact that when certain depositors, individuals saw the 10%, there was a lot of excitement that, 10%, wow. Because if you look at 10%, you ask yourself, if then that means we've even given up hope if it was really absolute 10% per annum on. So with that, GT banks, they already have low cost of funding, and I really don't expect much change. And like I told you, there's also an alignment with the other rates, like the 90-day rate for Treasury bills. I think it's about 1.14%. For 192 days, about I think 1.84%, and for 364 days, I think about 3.4%. So it means that your Treasury bill rate were actually lower than your savings account rate. So at the end of the day, there needs to be proper alignment, and I think CBN has done the right thing. But like I've said, our regulators, which is, as a researcher, one of the things I also struggle with is the fact that regulators need to understand that the consumer of their information is not just sometimes those that they've targeted. And so there must be some intentionality to ensure that, proper objective is stated explicitly in such circulars to ensure that people have a clearer perspective on the intention of the regulator.
I'm sure they've taken note of that. We'd like to thank you, Chief Executive Officer of Relation Consulting and WardGov, Dr. McLeish Otwedo. Thank you for coming on the program.
Thank you very much, and thanks to the viewers also.